Welcome, it's Rob, the Ignorant Entrepreneur. Let's jump right in with how you can secure Airbnb IPO. Now, I wanted to do this video because the last video got so much attention, and it seems like people are really interested in getting into this stock. So I wanted to talk more about ways that it might be accessible to the open investor. Now, with that being said, we can see all these high-profile public offerings coming up, and it's certainly going to be good to know how you can buy into an IPO. Airbnb, for example, recently filed IPO paperwork with the Securities and Exchange Commission, the SEC, and CNBC's Jim Cramer thinks the IPO will be a, quote, steal. Thanks to this little thing called the coronavirus, Airbnb is now the safest way to travel, which is why this IPO might end up being the steal of the century. It pretty much has the market to itself, Cramer said. The once mighty hotel and restaurant industries and their unions no longer have the clout to keep Airbnb down. Now, some you may not know, DoorDash, Instacart, and Coarse are other companies tracking toward an IPO. This is, of course, the rumor on the street. There's more information about it on NerdWallet. There's also Asana, which I really like. It's project management software. There's Compass, Double Down Interactive, Palantir, Snowflake, and even a personal favorite of mine, Robinhood. All companies in the process of being reviewed by the SEC to make an initial public offering. Wild, right? But when you have a market like this, it really incentivizes these companies to have these market valuations pushed to insane numbers. Now let's get into why you came here for how to invest in an IPO. Well, it's important to understand what an IPO is, an initial public offering. That's going to happen when a company first offers shares of stock to the public. Now, IPOs are used to raise capital, pay off debts, fund growth initiatives, raise the public profile, or to allow company insiders to diversify their holdings or create liquidity by selling all or a portion of their private shares as part of the IPO. Unfortunately, the underwriters of an IPO offer shares of the stock to their biggest, best, most profitable clients, says the U.S. News and World Report. That's why it's usually institutions, investment banks, and hedge funds that get to buy shares of the stock at IPO price, aside from the management, employees, and friends and family of the company. You, however, might be able to get an IPO if you have a good relationship with the broker taking the company public, and you're keeping many assets with that broker. But even that isn't a guarantee. For LinkedIn's IPO, for instance, unless you were friends or family, you are probably out of luck. I mean, Rob Lutz, president and CIO of Cabot Money Management in Salem, Massachusetts, says he manages $500 million and still he can't even really get hot ones. So, if you're determined to get in on an IPO at its offer price, though, it will extremely help you to have a relationship with a full-service brokerage firm instead of a do-it-yourself online brokerage firm, such as a Fidelity, for instance, instead of a Robinhood. Check your broker's website for rules and requirements of getting in on an IPO. Brokerages have formulas for IPO share allotment, and those formulas often rely on a client's assets, trading history, relationship with the brokerage, and crucially, risk tolerance. You know, not every IPO is going to shoot to the moon. Some are going to tank. I mean, look at a Lyft and Uber that shot up initially, but then tanked. Something to consider. If you selected conservative or moderate on your investment profile, you will not be able to participate. IPOs are considered speculative or aggressive from a risk standpoint. People who are lucky enough to buy into an IPO can sell their shares of the stock whenever they want, but be aware that brokerage firms discourage flipping and might even restrict flipper participation in future offerings. All this being said, if you don't get in on the IPO at the ground floor, so to speak, you can always buy shares once the stock is trading. But it's not uncommon for stocks to spike 80, 90, or even 100% on their first day of trading. LinkedIn stock rose more than 109% on its first day of trading on the New York Stock Exchange in 2011. Alternatively, you could wait to try buying into a lower profile IPO, one that doesn't have, say, Airbnb's visibility. Or you could invest in mutual funds that invest in IPOs to get a slice of that pie. Best of luck, investors. This has been Rob, the Ignorant Entrepreneur. Please feel more than welcome to smash that like button and subscribe. I'll definitely be following this scene a lot more closely. All right.